Most people think real estate wealth is built by finding one great deal. Family offices think differently. They are not trying to flip one property, hit one home run, or chase the trend of the month. They preserve capital, create cash flow, reduce taxes, control risk, and compound wealth for decades. That is the difference. An investor asks, how much can I make on this? A family office asks, how does this asset fit into the next 30 years of our balance sheet? That mindset changes everything. Family offices usually start with a pile of capital created from another business. Maybe it came from manufacturing, construction, energy, medicine, technology, logistics, or selling a private company. Once the money is made, the next question becomes, how do we keep it, grow it, and pass it on? Real estate becomes attractive because it checks several boxes at once. It can produce income. It can appreciate over time. It can be financed. It can provide tax advantages. It can hedge inflation, and if managed correctly, it can be controlled instead of traded. That control is important. Family offices are not buying properties just because the broker says the cap rate looks good. They are looking for durability. They want locations with long-term demand, tenant stability, replacement cost protection, and assets that can survive bad markets. They are not just buying buildings, they are buying income streams. A wealthy family may buy industrial properties, medical offices, self-storage, multifamily, land, or triple net leased buildings. But the asset type is less important than the strategy. The goal is to build a portfolio that does three things. It protects the original capital, produces predictable income, and appreciates over a long period of time. That is why family offices often care more about downside protection than flashy returns. An investor might get excited about a projected 30% internal rate of return. A family office may be more interested in a boring industrial property with a strong tenant, low leverage, and steady rent growth. Why? Because boring can be beautiful when it pays every month. Another major difference is leverage. Family offices use debt, but they usually do not want debt to control them. They may use conservative leverage so the property can survive vacancies, rate changes, repairs, and market cycles. They understand that getting rich and staying rich are two different games. High leverage can make returns look great on paper, but it can also turn one bad year into a forced sale. Family offices hate forced sales. They want optionality. That means they want enough cash reserves, strong banking relationships, flexible structures, and assets that do not require panic decisions. They also think deeply about tax strategy, depreciation, cost segregation, 1,031 exchanges, estate planning, entity structuring, and charitable planning can all affect how much wealth actually stays in the family. The wealthy do not only focus on what they earn, they focus on what they keep. Real estate is powerful because it can generate income while also creating paper losses through depreciation. That does not mean taxes disappear, but it can create timing advantages and planning opportunities. Over decades, those advantages can become massive. Family offices also build teams. They may have attorneys, CPAs, managers, lenders, brokers, contractors, and investment managers. The family may own the capital, but the system protects it. Wealth is not just money. Wealth is process. A good family office has discipline. It has investment criteria, reporting, governance, and someone asking uncomfortable questions before the money goes out the door. Family offices also understand concentration. If all the family wealth came from one operating business, real estate can diversify the balance sheet. Instead of having everything tied to one company, one industry, or one customer base, they start converting active business wealth into durable passive assets. That is how one generation's business success can become the next generation's financial foundation. But here is the part people miss. Family offices are not automatically smart just because they have money. Plenty of wealthy families lose money chasing bad deals, trusting the wrong people, overpaying, using too much debt, or confusing complexity with sophistication. The best family offices are not reckless, but patient. They would rather miss a deal than buy a bad one. They understand that wealth is built by making good decisions repeatedly, not by trying to look brilliant once. Start asking, how does this decision move me closer to durable wealth? That is how real estate family offices think. They are not just buying property. They are building a machine that turns capital into income, income into more assets, and assets into generational wealth. Subscribe for practical lessons on business, real estate, and the deals that make or break wealth.